Good afternoon, ladies and gentlemen. I'd like to welcome you to BDO's webinar, Documenting and Publishing Your Tax Strategy. Before we get started, all lines have been muted, so if anyone has any questions throughout the presentation, you will see there is a Q&A box on the lower right-hand side of the screen. Please use this option to pose questions to the speakers. We will try and cover questions at the end of the presentation. The presentation is being recorded, and we will share this with all the attendees after the webinar, and we'll also include the slides. So without any further delay, I'm going to hand over to my colleagues Ed Dwan, Lucy Sauvage and Angela Clegg, who will walk through this presentation with you. Over to you, Ed, Lucy and Angela.
Thanks, Greg. Afternoon, everybody. So, as Greg said, the base of today's webinar is to do with HMRC's new provisions around documenting tax strategies. This came out of the emergency budget last June, July, which produced a consultation on a number of issues, one of which was requiring all large corporates to publish their tax strategies on an annual basis. Following that consultation process, some draft legislation and guidelines, well, initially draft legislation came out in December 2015, and that was updated in March 2016 with some amended legislation and some detailed guidelines. So the purpose of today's webinar is to really talk you through what those rules say and then look a bit at the practicalities of how, if you're caught by these rules, you might want to go about documenting the strategy itself and giving you some insights into some of the ways that people have done this in the past, but also some of the things that may mean that even if you already have a tax strategy, you might need to update or refresh it to be fully compliant with the rules going forward. I guess the other thing to say is that what we'll focus on is both what compliant looks like, so what do you have to do to actually be in line with the legislation, but also maybe look at this in terms of a way of actually adding some value to the business as well. So therefore, there may be other things that aren't directly in the legislation, but you might want to consider doing because they're of a wider benefit to the business. As Greg said, there's a facility as we go through this for people to ask questions. I'll pick up on those questions at the end of this webinar. If there are things that are directly relevant to the slides we've got up there at a particular time, I might dive in and cut across the other presenters just to sort of pick up on those issues as we go through them. So without further ado, I'll pass on to my colleague Lucy Sauvage, who's going to take you through the nuts and bolts of the legislation and who is caught and how it works. Lucy, over to you.
Thanks, Ed. So as I said, I'm going to walk through the technical detail of the legislation before handing you over to Angela, who will discuss with you the more practical aspects you may wish to consider in relation to the legislation. So first of all, let's look at who this legislation applies to. Well, there are thresholds of £200 million turnover or £2 billion balance sheet totals which apply. Those of you familiar with senior accounting officer legislation will recognise these as being the same thresholds that capture companies for SAO purposes. So just a few slides now to really illustrate exactly the entities that are caught by the legislation. A very technical slide here, but included really for completion. Of course, any standalone UK registered business or a company that meets the thresholds in its own right will be caught. And as per SAO, the thresholds are applied to accumulated turnover over an asset of UK groups, capturing all UK registered entities within a 51% group. And that's regardless of whether they have a UK or an offshore ownership or structure, albeit that only the UK entity numbers are accumulated. And this particular scenario is actually, or has actually been, the most common cause of SAO failures that we have seen, where independently run UK entities with no visibility over results of the wider group have not realised they were caught. So that's just something that these small entities need to be aware of. Taking a step away now from the similarities with SAO, permanent establishments of foreign relevant bodies are going to be caught by this legislation. So if either alone or with other UK group entities they exceed the thresholds, they will be caught and will be expected to publish a tax strategy. Also, unlike SAO, partnerships exceeding the thresholds will be caught, and that includes all partnerships within the meaning of the Partnership Act 1890, limited partnerships registered under the Limited Partnerships Act 1907, and limited liability partnerships incorporated in the UK. So that covers who's caught by the turnover and asset thresholds, but there are another tranche of businesses caught by this legislation, and these are all UK companies within a multinational enterprise group where the group has a reporting requirement under country-by-country reporting, or who would do if the head company were in the UK. So that's any UK company that sits within an M&E group with a global turnover exceeding €750 million. This means that even the smallest UK-based companies will be caught if they fall within such a group. Now, HMRC's impact assessment for this legislation, when it first came out, indicated that around 2,000 businesses were going to be caught by this. And that number sits firmly in the SAO population arena, but we believe that this particular provision will bring in a lot more companies than that. And we did query this with HMRC when the draft legislation was originally published, as I believe did other advisors. HMRC have, however, confirmed that this is the correct interpretation of the legislation. These companies will be caught. We envisage that this will cause some considerable difficulties for businesses owned in overseas territories, such as the US, which have a much less transparent relationships with their tax authorities, albeit that it is only UK aspects of the tax strategy that need to be published. We still think that there's going to be some pushback and some issues with regard to what those subs can actually put into their document if that they are making public. There is some lobbying going on this point at the moment, and there's pressure for HMRC to introduce a de minimis. So we need to wait and see what's going to happen with that. But for now, we have to assume that if your business sits within an M&E group with country-by-country reporting requirements, or who would do if your UK was the top co, then you will need to publish a UK tax strategy. Furthermore, last week, an amendment was tabled to the legislation. It was tabled by a Labour MP, but with the backing of a mixture of Labour and Conservative MPs. And what, if this goes through, this amendment will require is that any group which is caught by the tax strategy legislation and which is also a part of an M&E group would need to include a country-by-country report within their tax strategy. As I say, this is a tabled amendment. It may not be legislated, and we don't know exactly what will be required under it. We believe that if it goes through, it will only be relevant to UK-headed groups, but that's not certain at the moment. You know, at the moment, if we take it at face value, this could be a very controversial addition to the requirements. Again, particularly for US-headed groups. I understand that the US have pushed back to an extent on country-by-country reporting as it stands at the moment, and with their provision being that, you know, they don't want their CBC reports being made public. So if it's actually required to be made public under UK legislation, that's going to be a big problem. So we'll have to see where this one goes, but it's to be aware of. Okay, so that covers who's caught. But what do HMRC mean by a tax strategy then? Well, they're looking for a high-level strategic document which sets out the overriding tax objectives of the business aligned with the company's commercial strategy. So if a business is looking to expand into new territories or is expecting to expand rapidly over a short period of time, HMRC would expect the tax strategy to reflect that and have sufficient provisions in it for the business to be able to deal with their tax affairs in line with that commercial strategy. As I mentioned before, the published document does need only to refer to the tax affairs relevant to UK tax, but for global groups there needs to be some consideration on where to draw the line in that respect. HMRC are clear that they expect this to be more than just a one-off statement, and they want to see that the strategy is embedded into the business and supported by a framework of processes and controls and an active risk management framework. And this is where HMRC note that they see businesses struggle. It's with actually embedding a documented tax strategy within the day-to-day operations. So this is going to be a real challenge for businesses. As HMRC are mandating that they want their CRMs to be talking to businesses around this point and to really be challenging and making sure that the way the companies are running is in line with what's in their tax strategy. So businesses can include as much information as they wish within the strategy document, and Angela will discuss shortly some of the additional areas businesses may want to include, but there are 4 areas which are actually prescribed in the legislation as being required. The first required area is a description of the business's approach to tax risk management and governance. The guidelines to the legislation suggest what maybe should be covered under each section. Now, they are only suggestions. It's not a list of sort of compulsory elements to include, but this is what they have put down into the guidance. So under this particular heading, they've suggested that you may wish to include commentary on how the business identifies and mitigates inherent tax risk, the governance framework the business uses to manage tax risk, the levels of oversight and involvement of the board, and a high-level description of any key roles and responsibilities and systems and controls in place to manage tax risk. Now, in some ways, essentially here businesses need to be talking about the framework they have in place to ensure that they're paying the right tax at the right time. And in some ways, this section shouldn't be too difficult to write. So, because as long as you sort of actually have decent risk and governance measures in place, it can be fairly factual. But some consideration does need to be given to the content here. For example, if in answering how the business identifies and mitigates inherent tax risk, you refer to the keeping of a tax risk register, you need to be aware that HMRC could and probably will ask to see that tax risk register. Now, it doesn't mean you have to actually show it to them, but you need to be prepared to have your reasons for not doing so and answer that question if it arises. And another tip on this particular point, I've seen some fairly comprehensive tax strategy documents which go into a lot of detail to cover off how risk associated with large or unusual transactions is dealt with, but make no mention of the sort of processes and controls in place on a day-to-day basis to ensure that the right tax is being calculated. And I think HMRC will expect to see some commentary regarding that under this heading, so it shouldn't be forgotten. The second area which needs to be covered is the business's attitude to tax planning, and the guidance suggestions for what should be covered here are details of any code of conduct regarding tax planning, an outline of the drivers of tax planning and the weighting given to these in formulating tax strategy, the group's approach to structuring tax planning, and an explanation of why tax planning advice may be sought externally. So in most tax strategy documents I've seen to date, references to the attitude to tax planning have been fairly brief and often one-liners referring to commerciality, and companies may need to expand on this area a bit, add a bit more colour to it in order to sort of satisfy HMRC. So it's not going to be one of the easiest areas to sort of put your thoughts down on paper. Some considerable thought, I think, is going to need to actually implementing or actually documenting this part of your tax strategy. Very important in drafting this section is consideration of the language to be used. HMRC commissioned a report last year which looked at tax strategies, and from this have aligned certain language with high and low risk behaviour. So, for example, references to acting within the law would indicate to HMRC higher risk attitude, whereas acting in the spirit of the law demonstrates low risk. And there's a whole series of sort of other phraseology and language that HMRC sort of now correlate with certain behaviours. So just some care required in the actual language used in this section or when referring to tax planning within your document. Now, the third area to be covered is a description of the level of risk that the group is prepared to accept. Now, this is quite a tricky one to answer, and we did hope that the guidance when it came out would be would be good guidance and would provide us with some advice on this. But really, all they provide is a one-liner, which is an explanation of whether internal governance is prescriptive on levels of acceptable risk, and if so, is this quantified, and how is this affected or influenced by stakeholders? Okay. I guess you could put a statement in there saying, no, there's no prescribed level of risk deemed acceptable by the company, but would HMRC view this as being a lack of governance or control? Quite possibly. But how then do you articulate what levels of risk are acceptable or not for your business? Some businesses may apply financial thresholds, some may apply sort of more certain than not principles. In essence, this is a very subjective area. It will, what is the right way of prescribing levels of risk for your business will be very different to the next business depending on the type of transaction, the size of transactions, and nature of transactions you enter into. But we would recommend that companies do try and come up with more than just a bland statement in the respect. As again, bland statements that don't really say too much in this area have been noted from HMRC as being sort of been designed to give businesses maximum flexibility. And again, they're more likely to read this into this as indicating a higher risk behaviour. The final area required legislatively is a description of the business's approach to dealing with HMRC. And the guidance suggests that this may include an explanation of how the group works in partnership with HMRC to meet statutory and legislative tax requirements, and how the group is transparent or works with HMRC on current, future or retrospective tax risks, events or interpretation of the laws across all relevant tax and duties. Clearly, what HMRC are looking for are references to open, transparent and real-time collaborative working. And this section shouldn't be too hard to draft, but it does, of course, have to be backed up in reality and actually reflect what your relationship with HMRC is like. Okay, so I've covered off there who is called and what is legislatively required to be included in the tax strategy. So I'll now pass on to Angela, who will talk you through some additional and practical considerations in dealing with this legislation.
Thanks, Lucy. So I think Lucy alluded to this. So this is areas that may have not been referenced in the guidance or the legislation, but we think, a number of clients find it useful to include. I also think considering areas such as this, it helps your tax strategy not look boilerplate or standard. There's a clear message from HMRC to move away from sort of, as Lucy said, bland vanilla statements and boilerplate documents. So including sort of outside, it's not necessarily been referenced in legislation, can help with that. So most large businesses in their tax strategy would include a note about how they deal with professional advisors, how's that managed. There is also in the guidance, I think, a line that says an explanation of why tax planning advice is sought externally, and actually looking at how you manage professional advisors might be a more delicate way of dealing with that aspect of the guidance. The tax strategy can include aspirational goals. So one client said they wanted a zero tolerance on penalties, for example. Just have to take care of aspirational goals, that there is some evidence of trying to embed that across the organisation, that they're trying to achieve that. So if you are a global organisation and going to take an approach of zero tolerance on penalties, well, how do you make sure that the right people are alerted at the right time, that any deviations from those aspirational goals, are identified and remediated? There's also, the legislation is quite clear that this, expects large businesses to publish what is relevant to UK taxes. Now, in reality, for inbounds, we think this might be a difficult part of legislation because, many inbound clients will say, well, my strategy is really governed from overseas. We're quite dependent and influenced by that. So for those companies, there may be a decision on do we publish a global strategy. Again, depending on where the headquarters, there may be more sympathy for that than certain jurisdictions. We know that certain jurisdictions, are not really on board with the concept of a tax strategy yet. There may be sort of media considerations around that. Does the group want, more than what is required in the public domain. But for some companies, there will be consideration of this. But a global strategy is still compliant, providing it covers off what's relevant for the UK as well. Quite a number of companies are choosing to use relevant appendices. So quite a popular one is a corporate and social responsibility appendix, particularly if the big part of their strategy is they're ethical in their approach to tax. Then a corporate and social responsibility appendix shows that the wider business is akin with that. They're an ethical business. Corporate governance, more detail around that can be helpful. It can link into how you're managing risk. And as we've mentioned before, HMRC want to see the tax strategy aligned to the business strategy and to see that they're aligned to each other. So to include your business strategy can be helpful. Obviously, that will probably be a watered down, narrowed down version in many cases, but something to think about. So we don't think it'll be often, but some companies may choose to include their effective tax rate. Again, unless there's really a commercial driver for that, potentially, the pioneering themselves a very ethical business, or they've been subject to sort of media scrutiny in the past. We don't really think that'll be very common, but some people may choose to do that. So I thought it'd be helpful as well to set out, Lucy set out helpful what a tax strategy is, and sort of some other documents what it's not. So there is, companies can also draft a tax policy document, which is a more detailed, it's expanding on the tax strategy. So the tax strategy might set out the board's view on risk, but then the tax policy document will say, well, actually, how do we ensure this happens? How do we ensure that the risks are identified and the right person's informed of these risks? Is there a risk escalation procedure? A tax policy document can be quite helpful as well if groups are particularly sensitive about what's in the public domain. Now, obviously, there's the requirement to publish certain things, and it must meet the legislation. But they may choose to have a tax policy document because they can add more colour to that, and potentially in a format which is suitable for sharing with the revenue, for example. But they may not want to put it on the company website. You can also reference, more detailed guidance notes around how returns are filed, VAT return submission procedure, that kind of thing. Tax risk. So moving on to the next one, a tax risk register is also something that can help support your tax strategy and sort of demonstrate to the revenue the manner in which you're embedding it. But again, as Lucy mentioned, we have seen appear, recently the revenue asking for those, so that just needs to be carefully managed. But a risk register, again, it tends to sort of identify the key risks and quantify those in many cases, and also prioritise any remediation works. So publishing requirements. So again, getting asked quite a bit from clients actually, when's the sense that people are going to publish these? And I'd say it's varies. Some clients are choosing to early adopt. I think there is quite a few clients that are saying, well, actually we'd quite like to wait and see what everybody else does. But I think there is a general consensus that a lot of people want to think about it earlier. They recognise that it needs to be published, there could be media interest, and therefore we need to think about this a bit earlier. But in terms of what the actual legislation says, well, it's an annual requirement, and it must be published before the end of the financial year. So in terms of when does it come into effect, it's for accounting periods commencing on or after royal assent. So for most people, that's going to be 2017 accounting period. Now, we anticipate with all the referendum that royal assent will be delayed. We're hearing whispers that will be in October. So, we're looking at sort of November 17 being the first period that we thought that most companies fall in, November, December 17. So yeah, it needs to be published before the end of the financial year. The revenue have also just put a little tweak in the legislation to sort of make sure there's quite a regularity in it being published. So they said it must be published the second one must be published not less than 9 months and not more than 15 months after the first one. So what they're trying to do there is stop the situation where December year end publishes on 1 January one year and doesn't publish again until the 31st of December the following, so you have almost a 2-year gap. Now, we did speak to the revenue about you know, about their view of the tax strategy, and they accept that it is a longer-term document. So what they want is they want, you know, the senior people in the business to be considering the tax strategy regularly, but they accept if there's been not any, you know, significant deviations in the business strategy or the size of the business, for example, that, you know, the tax strategy may not change a great deal each year, but they want evidence on a, you know, relatively frequent basis that this is being looked at and approved at board level. So that's that little tweak there. It must be published on the internet. It can be a separate document or part of a wider document, and they've been very clear in legislation that it must be made available free of charge for a minimum of 1 year or until the following year's strategy is published. The guidance states that businesses should indicate to HMRC when and where their tax strategy has been published. That isn't in the legislation, but it is in the guidance. Now, for those companies that, for example, don't have a CRM, you know, it might be quite difficult to actually tell the revenue when and where you've published it. But for those that have a CRM, it probably would be worthwhile just making them aware of when you've done it. So I think we've covered off the next slide. So there is some penalties for non-compliance. So there's for failure to publish a tax strategy that meets the legislative requirements within the prescribed period, or failure to keep the strategy accessible for a minimum of 1 year. Now, in terms of failure to meet legislative requirements, what we do expect CRMs to be, you know, looking at, we're advised them receiving training, and they should be looking at, you know, what the business is doing, and if there's some substantial differences from that in the strategy, then that should be challenged. But, you know, in terms of actually levying penalties, you know, there may be more administrative ones from a timing perspective, but we are advised that CRMs are being trained and they should be challenging, you know, if what's going on the ground does not accord with what's in the tax strategy. So the penalties, the immediate penalty is $7,500. If the failure is still outstanding after 6 months, there's a further $7,500, and then monthly thereafter. But again, we'd hope that, you know, most people won't be in that position. And the revenue has been quite clear actually for some time, so not just since legislation came out, but for, you know, at least a couple of years, if not longer, that they expect, you know, large businesses to receive a low risk rating. They expect them to have a documented tax strategy. So again, we're advised that CRMs are going to be to look at this. They're going to be trained to look at this as part of the business risk review meeting. So then we move on to how, in terms of our advice on, you know, how you might go about drafting a tax strategy. Again, you know, it varies from business to business, but we think there's a few key things which will help. So one of the key things we think to making a tax strategy successful is getting all the stakeholders buy-in from the outset. I mean, there's a couple of reasons for that. You know, one is it's going to be much easier to embed in the business if you've got all the senior people bought in. I mean, we have, for example, we have a client, Japanese inbound client, that, you know, is really, really positive about this legislation because he feels like he would like, you know, tax to be on the boardroom agenda more and more support. So this is a perfect opportunity for people in that position to actually engage with the relevant stakeholders. There's also another point that, you know, we have seen in the past few years, you know, journalists look at clients' accounts and, you know, look at information around tax, you know, and publish a story. Tax has become newsworthy. There's an awful lot of media, you know, media debate around it, and therefore, you know, to get all the senior people bought into this strategy, you know, rather than sort of giving a cursory glance over it on the 20th of December before it's due in, you know, that's going to be really important that this isn't really on one person's head, if you like, because if in 6 months' time, you know, a journalist looks at the strategy and interprets something, you know, it's important that everyone's been bought into this. So articulating the tax strategy is probably one of the hardest parts of the process. Once that's done, it's about documenting that, and again, thinking back to the use of language, you know, taking care on that, because the revenue can interpret sort of bland, vanilla statements in the wrong way. So careful with your documentation. And then it's thinking about implementing the tax strategy, because again, the revenue have always been very clear. you know, they've criticised a lot of businesses for having a tax strategy, but effectively it's a piece of paper that's dusted off, you know, probably not even every year, and it's not really, you know, indicative of what's going on the ground. So you need to think about how do we implement that? You know, what are our resources and capabilities? Do we need any extra resources? And then it's important to how you can actually monitor that you are, you know, meeting your aspirational goals as well, and that any deviations from the strategy, you know, would be identified. And then each year there'll going to be an element of review and formal sign-off by the board, and, you know, make sure that, you know, any changes to the strategy are documented and, you know, it's all signed and approved. So the next slide looks at something Lucy alluded to earlier, so I won't dwell on it for too long. But it was a study that was commissioned, it was an external study commissioned by HMRC, and they looked at 30 large corporates, and they basically interviewed them, talked to them about strategy and their view on risk. And what came out of that is that, you know, the advice to the revenue was by these consultants was that, you know, the use of sort of vanilla words like compliance and transparency were generally indicative of businesses trying to sort of impute the maximum flexibility for deviation from the strategy, or give themselves maximum flexibility to act in the way they wanted. And therefore these words, compliance and transparency, could be more indicative of higher risk. They said that more detailed strategies, you know, indicated more of a focus on transparency. So the message really from this is just, you know, needs to be really well thought about the language. It's just a key message to take away. So we thought as well it'd be worthwhile summarising, again, the benefits of having a documented tax strategy. I think we've already alluded to one. So again, it gives an opportunity to get board buy-in to tax and more board involvement. It's a solid foundation on which to develop systems and controls. So we undertook, you know, a workshop around tax strategy with a client, and then coming out of that, they said, to meet this, we absolutely need an in-house VAT resource. And it became, you know, very clear from that, which, you know, it sounds something quite obvious, but actually till you get all the right people in the room and think about it, and where do you want to be, and how do you meet that objective, you know, they needed that clarity. So again, greater awareness of tax across the business, and also it's a useful document for HMRC interactions, and particularly for those businesses that, you know, are a low risk rating or want to maintain it or wish to be low risk. I think it's also a really good document to, you know, educate the business on media interactions. So another tax strategy tax strategy workshop we did, we realised that some of the LinkedIn profiles of the directors are potentially a bit contentious. One talked about tax planning in Luxembourg, to which they said, well, that needs to come out. So it's really thinking about your media profile, and it's educating. So if people ever are interviewed, you know, how do you answer these questions? What is the view? And it gives a consistent approach on that. So again, some clients will already have a tax strategy, so it might be more about developing that. So there's some key things to think about. So maybe quite obviously, does it meet the requirements of the new legislation, the 4 key areas? Now, has the business changed? Has the ownership, leadership, has the strategy changed? You know, the market conditions, are you operating in more jurisdictions? That needs to be factored in. You know, what's the company's risk profile now? Because the risk management framework needs to develop with that. I mean, and one of the biggest things is the tax landscape has changed significantly. So what was acceptable, you know, even potentially 2 years ago, but certainly, you know, 5 years ago, it's not acceptable now, many people would argue. So you need to think about, you know, does it need updating to reflect the current environment? And one of the key things as well is the strategy embedded across the organisation? And probably another thing to think about is, would it be acceptable to be made public? Because obviously many tax strategies that have been drafted previously, you know, were not made public. So embedding a tax strategy, I think we've touched on this a little bit already. So it's identifying gaps in your systems and processes that, you know, that need addressing. So, if you're going to say we have a zero tolerance on penalties, how are you going to make that happen? How are you going to define whose role is it? Where are the responsibilities? And making sure that, risks are identified on a timely basis. There may be thoughts about how you develop a risk register or how you maintain it on a more timely basis. But I think really it's making sure that the statements you're making, you can actually evidence to the revenue that stuff is in play in the business to bring that to life. But I think on that note, I think there has been some questions coming in, so I will hand back to Ed.
Thanks, Angela. Yeah, so thanks everyone for, so obviously people have been paying good attention, which is great. So we've got a few interesting questions. One point of clarity first, and I guess the reason for the slight confusion in this area is we're still waiting to know exactly when this legislation is going to get signed off. But a number of people have asked questions around precisely when this legislation will bite. So the way it's worded at the moment is that once Royal Assent has happened, it will impact the next accounting period that commences after Royal Assent. So, as Angela mentioned, we think Royal Assent is going to happen in October this year because of Brexit. Assuming that's right, then it will be your accounting period that commences after October 2016. So, for a December year end, that would mean the first period would be 31st December 2017, and for a March year end, that would be the 31st of March 2018, just to give you an idea.
And just for clarity again, it's the last day of that financial year in the first year that you have to publish by. So if you've got a December year end, it would be 31st of December 2017, that it needs to be up and posted on the internet.
Yeah, and that's an important point actually that Lucy just made there, because I know when the revised legislation came out, there was a bit of wording in it that sort of made it look like it needed to be in place on the first day of that period, but it isn't. We've had that clarified, and it's clear from the guidance that it's actually the final date. So that's that one. There's a question around: is there any sense of who needs to have formally signed the strategy off for HMRC each year, equivalent to the SAO sign off? Does it have to be UK tax manager or someone else? Well, the straight answer to that is this needs to be board approved. So there needs to be some evidence that the board has actually signed off on this. And I suspect, we're not clear, but I suspect what will happen in the fullness of time is the revenue may ask questions around has this been documented, the board approval, i.e. was it put to a particular board meeting, etc. So they are keen, in other words, for this to be accepted by the entire corporate rather than an individual. So, which links into another question that there's been around the penalty position and whether or not that's levied on an individual or at the corporate level, and it's levied at the corporate level. So unlike senior accounting officer, it is not a personal penalty, it's a penalty on the corporate. They did think about doing it, apparently, at the individual level, but decided against it. So if there isn't a UK board, you've only got an overseas board, then the overseas board will have to approve it. But it needs to be, the appropriate high authority that is able to sign this off. And if you think about it logically, that does make sense, because fundamentally this is about strategy, and strategy should be set by the board. And I guess it's probably indicative if it feels too detailed, then it's probably falling into the realms of a policy document rather than a strategy document. So we then have someone asking a question about a multinational group that they're part of that doesn't have a UK-specific website. Do they have to publish on the parent company website? And the answer to that would be yes, and that will work so long as that website is accessible or freely accessible from the UK, because that's what the legislation says. So the legislation doesn't demand that the website website is hosted in the UK. It just needs to be freely accessible to all members of the public from the UK. This is an interesting one. So someone said, in your experience, what are the factors being considered by businesses when scoping out their levels of acceptable risk? I would say this is a really difficult area to be prescriptive on, and will depend on the businesses generally and their general approach to risk. But to give you an idea of the sorts of things that have been looked at here by other companies, I mean, one is clearly when you're looking at doing certain transactions, what is the risk of challenge from HMRC around that transaction? So in other words, there is often something in there that recognises where you know that you're taking a view on a transaction where there is a strong risk of challenge, maybe because you've seen HMRC guidance and that's contrary to the view that you're taking, then quite typically there would be some mechanism for giving the company comfort that that's a reasonable position to take. So the sorts of issues that will be identified in that there might be financial limits. So there might be, for argument's sake, any transaction over a certain amount of money might need a second opinion or an external opinion, could even require QC opinion. So different organisations operate in different ways, but I think the key message around this is that you do need a clear mechanism for escalating and making sure that those rules are consistently applied. But I think it would be wrong to be prescriptive around that. That depends on the organisation. And in particular, I think the bit that has changed dramatically in this area compared to when I first started advising clients on tax strategies about 10 years ago is the reputational risk. So 10 years ago, most people's concern around tax planning from a reputational point of view was the desire not to appear on the front page of the Financial Times. These days, people don't want to be on the front page of the Daily Mail or the Times. It's suddenly become a much more live issue, and therefore you have to be so much more careful around the positions that you take. And I think a lot of that is areas where you really will need some guidance from the board. Which links in, I guess, to another question that's been asked around, is there any benefit to actually undertaking this exercise sooner rather than later? So would there be a significant benefit in doing a tax strategy this year in 2016 before you actually have to do it? And I think the answer to that is that it depends again on your circumstances. So I think there are potentially some brownie points to be had from HMRC by actually having this in place, and particularly therefore if your risk profile with HMRC is up for debate and you want to achieve low risk, there may be some benefit in doing that. I think the other thing I would say is I wouldn't underestimate, particularly if you're quite a large, complex organisation, just the length of time from start to finish one of these projects may take. Because if you are going to have to get this signed off at board level, in my experience, it's quite common for a draft to go to the board and the board to come back with further views and then the final draft to take some further time. So therefore, it can take from start to finish, often, 6 to 9 months to get the whole thing actually formally approved and onto your website. So others may be able to do that an awful lot quicker, but I would just advise that it's not something that's necessarily a very straightforward process.
No, there's a few more questions coming in here, Ed, so I'll just read them out to you. So does the strategy document need to cover all taxes, VAT, pay-as-you-earn, corporation tax, etc.? The response to that is yes, it does. It needs to be fully inclusive of all those taxes. If a UK group, which is caught by virtue of being owned by a larger multinational enterprise, is caught, So it's a UK group. Sorry, does each company in the group need to publish a tax strategy, or can it just be the top UK company? My understanding is that you can produce one tax strategy for that UK group, so as long as all those companies adopt it. And the secondary question is who signs it, the UK or overseas? Well, if you've got, I think if you've got a UK board, it's a UK board. But I think, as Ed mentioned before, if there's no UK sort of board or equivalent, then it would need to go higher up.
One more question here around whether or not, what are the sort of upsides, downsides to having either a UK focused tax strategy or a global one. And I think on this, obviously for pure compliance purposes, it simply needs to be UK based. But I think if you are a UK headquartered multinational, there are wider business benefits of maybe looking at the global piece and having a consistency globally. But as far as we're aware, there aren't any other jurisdictions at the moment that have a specific piece of legislation formally requiring a tax strategy to be in place in that particular territory. So therefore, it's not essential that you do that, but I think it's something worth considering. I think the flip side is probably true if you're US owned. In our experience, the relationship between US corporates and the IRS is somewhat different, shall we say, than UK corporates and HMRC, and there is certainly no intention of the IRS to introduce this type of legislation, and in our experience, US boards find the whole thing somewhat bemusing, I think it's fair to say. So therefore, if you can do this without having to get them too involved, other than them signing off on the UK element of it, you're probably in a better, easier place than creating a hard thing for yourself to do in terms of implementing something more global.
There's another couple of questions just come in there. Could you just include this within your board minutes having been approved? I'm assuming the question there is that you documented evidence of board approval. I would say yes, that's your documented evidence. I think that would be perfectly satisfactory. And the second question there, does it have to be full board approval, or could it be a subset of the board, such as the audit committee? There is no specific guidance on this. Again, I would anticipate that if you've got an appropriate level at board level, then I would imagine that would be adequate. So I would say audit committee sign off. So long as you've got board members on your audit committee and the board is generally aware of it, I suspect that would meet the requirements.
I think that's right. The one other bit, we made reference to things like tax risk registers, etc., and where do they sit in all of this, and whether or not HMRC have the power to access those. So it's quite a contentious area, this, at the moment. Just so people know, we're aware of a number of clients recently who've made reference to tax risk registers in certain documents that they've given to the Revenue, and as a consequence, the Revenue have asked for copies of them. Our view on that is that you should resist passing those documents over, because those documents were never intended for HMRC. They were intended as internal risk documents. In our experience, the Revenue have always pulled back from formally requesting them. We see those as part of good internal governance, and should the Revenue just routinely ask for copies of them, ultimately they're likely to change character in nature and just become bland statements that are fit for sharing with HMRC. So we would very much urge people not to feel compelled to have to comply with those requests. And as I say, to date, we're not aware of the Revenue actually making those requests any more formal. And I think
there are a couple more questions to come through. They're not directly related to tax strategy, so if it's okay, we'll pick up on those offline. Just check, no more questions coming through. No, okay. Just so everybody knows, we will be circulating the slides after the recording. so we'll send those through to you. Clearly, if anyone has any questions or any further questions or wants to discuss any of this any further, please feel free to contact either myself, Ed, or Angela. Our contact details are available on the slide pack.
And the one further thing I'd say is once we get clarity on that amendment that Lucy talked about earlier on, if there's any more detail comes out on that, or indeed whether or not it's actually likely to be enacted, we will let people who are on this call know that as well. So, finally, just to say thank you everyone for listening. I presume you have been listening. We'll say that as read. So, and thank you to my co-presenters, Lucy and Angela, and to Greg for organising the whole thing. Thank you, everyone.
Thank you.